What if the wealthy are not smarter than you, not luckier than you, and not working harder than you, but they are simply moving earlier than you? What if the gap between where you are financially right now and where the top 1% sits is not about income, not about inheritance, not about connections, but about timing? About knowing which moves to make before the rest of the population even realizes those moves exist? Because that is exactly what the data shows. The rich do not wait for financial trends to become mainstream. They do not wait for CNBC to confirm it. They do not wait for their neighbor to bring it up at a barbecue. By the time the average American is talking about an opportunity, the wealthy have already positioned themselves, already captured the early gains, and are already thinking 3 moves ahead. Today, I am going to show you 3 specific financial moves that wealthy Americans make early, before the masses notice, before the media covers it, and before the window starts to close. If you understand these moves and you act on them, you change your trajectory. If you ignore them, you spend another decade watching the wealth gap widen and wondering why. Welcome to Wealth Analysis Network, the channel where we break down how money actually works in America, how the wealthy think differently from the rest of us, and what specific, actionable moves you can make right now to start building real, lasting financial leverage in your own life. If this is your first time here, subscribe right now because every single video on this channel is designed to give you the kind of financial insight that most people only stumble across by accident, if they stumble across it at all. Let us get straight into it. 3 financial moves the rich make early, before everyone else notices. Move number 1. They buy assets when they are boring, not when they are exciting. Here is something that almost nobody talks about, but that every wealthy investor understands at a deep level. The best time to buy an asset is when nobody at your dinner table is talking about it, when it is considered dull, when the financial media is not running segments on it, when your coworkers are not asking you if you have heard about it yet. Think about what happened with real estate in the early 2010s. The 2008 financial crisis had collapsed property values across the United States. Foreclosures were everywhere. The public narrative around real estate was toxic. People were terrified of it. The average American was running away from property as fast as possible. What were wealthy investors doing? They were quietly buying tens of thousands of properties, purchased at historic lows, from families who were panicking and from banks that were desperate to offload inventory. By the time the general public started feeling confident about real estate again, by the time property became exciting and aspirational once more, those early buyers had already accumulated enormous equity. The window had not closed, but it had narrowed dramatically. The easy money, the outsized early gains, had already been captured. This pattern repeats across almost every asset class. Index funds were considered boring and unsophisticated for decades before they became mainstream. The wealthy were loading up on low-cost index funds in the 1980s and 1990s, while financial advisors were still pitching actively managed funds with high fees to everyone else. Commercial real estate, farmland, REITs, dividend-producing stocks, the pattern is always the same. Wealthy buyers move in during the boring phase. Everyone else moves in during the exciting phase. And the exciting phase, by definition, is when the best gains have already been made. The move for you is simple to understand but genuinely difficult to execute because it requires emotional discipline. Stop waiting for an asset to feel safe. Stop waiting for the consensus to form. Study the fundamentals. Understand what you are buying and why. And if the fundamentals are strong and the asset is still in its boring phase, that is your signal, not a reason to wait. Move number 2. They aggressively protect their income from taxes before accumulating wealth, not after. This is perhaps the single biggest financial mistake that middle-class Americans make and that wealthy Americans almost never make. The average person thinks about taxes at the end of the year. They earn, they spend, they save what is left, and then in April they find out how much they owe and they write the check. Tax strategy is reactive. It is an afterthought. Wealthy Americans operate in the complete opposite way. Tax strategy is built into every financial decision before the decision is made. They are not thinking about how to minimize the taxes on money they have already earned. They are thinking about how to structure the earning, the investing, and the spending so that the tax burden is reduced at every single step along the way. What does this look like in practice in the United States right now? It looks like maximizing contributions to tax-advantaged accounts before touching taxable accounts. A 401k, a Roth IRA, a health savings account. These are not just retirement tools. They are tax shelters, and the wealthy treat them as such. A high-income earner who maxes out a 401k and a backdoor Roth IRA every single year for 20 years is capturing an advantage that compounds dramatically over time compared to someone who invests the same total dollars in a taxable brokerage account. It looks like structuring business income correctly. Wealthy Americans who own businesses, and most truly wealthy Americans do own some form of business, are meticulous about entity structure. An S-corporation, an LLC taxed as an S-corp, a properly structured sole proprietorship, these are not exotic tax evasion schemes. They are legal structures that the U.S. tax code explicitly provides, and they can reduce self-employment tax and income tax by tens of thousands of dollars per year for people who know how to use them. It looks like timing income and capital gains strategically, knowing when to realize a gain and when to defer it, knowing how to use tax loss harvesting to offset gains, knowing how depreciation on real estate can shelter income from taxation in ways that most people have never even heard of. The wealthy have CPAs and tax strategists who work on this proactively, year-round. You may not have that yet, but the move you can make right now is to start thinking like they do. Stop treating your tax bill as a fixed cost. It is a variable. And the earlier in your financial journey you start treating it that way, the more of your own money you keep. Move number 3. They build and monetize networks before they need them, not when they need them. In America, the phrase net worth is well understood. The phrase network worth is not, but it should be. Because for the genuinely wealthy, the network is often the mechanism through which everything else is accessed. Deal flow that never hits the public market. Investment rounds that are closed to the general public. Job opportunities, partnership opportunities, information advantages, all of it flows through relationships. And the wealthy understand this so deeply that they treat network building as a financial strategy in its own right. The critical word here is early. The mistake most people make is trying to build a network when they already need something from it, when they have lost a job and need a new one, when they have a business idea and need funding, when they are trying to break into a new industry and need introductions. Networking from a position of need is one of the least effective and most uncomfortable forms of networking that exists. The other person can feel it. The energy is off. The relationship starts transactionally, and it usually stays that way. Wealthy Americans, and specifically those who built wealth rather than inherited it, almost universally describe their networks as something they invested in before they had a clear return on that investment. They showed up to industry events when they were junior. They introduced people to each other generously, with no expectation of reciprocity. They added value to relationships before they ever extracted value from them. And over years and decades, those networks became the infrastructure through which their financial lives operated. In practical terms, for the American context right now, this means several things. It means identifying the professional communities, the mastermind groups, the industry associations, and the online networks that are populated by people 5 to 10 years ahead of where you want to be, and investing time in those communities now. It means developing skills and expertise that make you genuinely valuable to other people, not just likable. It means showing up consistently and visibly in spaces where opportunity is generated, not just in spaces where opportunity is consumed. The return on this investment is not linear and it is not immediate, but the wealthy understand that the biggest financial opportunities in America are almost never accessed through a public channel. They flow through trust, and trust is built before it is needed. Here is what I want you to take away from everything we covered today. The financial gap between the wealthy and everyone else in America is not primarily a gap in intelligence, in luck, or even in raw income. It is a gap in timing and in strategy. The wealthy buy boring assets before they become exciting. They protect their income from taxes before they accumulate significant wealth, and they build networks before they need them. None of these moves require you to be rich already. Every single one of them can be started from wherever you are right now. The question is not whether you have the resources to act. The question is whether you have the awareness and the discipline to act before everyone else does, because that is precisely what separates the people who watch wealth accumulate from the people who accumulate it. That is what we do on Wealth Analysis Network. We bring you the moves, the mindset, and the specific strategies that create real financial leverage in the American economy, explained clearly, grounded in data, and actionable for wherever you are in your journey right now. If this video gave you even one idea that changes how you think about money, please share it with someone in your life who needs to hear it. Subscribe to Wealth Analysis Network so you never miss a breakdown. And drop a comment below. Which of these 3 moves are you already making, and which one are you going to start this week? I read every comment, and I want to know where you are in your journey. Until next time, move early, move smart, and keep building.